Ole, Oystein, these guys need no introduction, but I will quickly just say a little bit about them. Ole has been with SFL, which has been celebrated its 20th anniversary on the New York Stock Exchange. Congratulations. And Oystein is the CEO of two public companies, Avance Gas and Flex LNG. So gentlemen, have fun and take it away.
Okay, thanks for joining this panel. Finally, we have time to shoot back at the analysts. But maybe we should do an introduction. The shipping equity stocks have been on a boom. So I was looking at the data here last week. So if you invested in the Oslo Stock Exchange Shipping Index, you would have done better than buying into the Magnificent Seven. And of course, the Oslo Stock Exchange Shipping Index, a lot of those companies are also listed here in US, like Frontline, Golden Ocean, Flex, etc. So where can we make any money these days?
And maybe just to add to that, you would be hard-pressed to lose money over the last year. I think, vessel values up 10% gross with leverage. We're talking, 15, 20%. So it's kind of interesting, Petter. Where did you go wrong last year?
The one thing which I got wrong, if you compare things with 1 year ago, is the container markets. If you asked me last autumn for any prediction, which I felt certain, I would say that the container market is going to be very bad in 24 and probably even worse in 25. Now it's all-time high rates, with the exception of some quarters in 2022. So it was possible to step wrong. I've spoken to investors that were short car shipping on the expectation of those rates coming down. That was not a view I shared, but it's always possible to do wrong, Ola. You know that.
And then John, how about you? If you look apart from the obvious one, like Frontline or sort of the no-brainers, but any stock where you recommended that you actually had to think through and you had to sell to shareholders?
No.
Or investors?
Nothing wrong. Listen, I did the smart thing. I whittled my coverage down. I only cover 8 tanker companies, down to 7 now. Had buys on 7 of them. They've all worked spectacularly. My neutral's been Nordic American, which has been a massive laggard, kind of an unfavorite favorite of mine for probably 15 years. And yeah, it's all worked out pretty well.
What about you, Frode? What do you like these days?
Well, I still like tankers. It's the same story, really. I've been advocating tankers since 2021, I guess. So it's been a great story. I think there's still a lot to go, really.
When will Basta make $100,000 on his VLCCs?
Probably next year. It's probably a bit too early this year. I'm guessing and hoping for 80,000 this fourth quarter.
You're humble.
Yeah.
And then, to Omar, when we mentioned Basta and Frontline, now it's sort of a $5 billion plus company. Do you sense that investors do they focus differently? Does it matter with that size, or is it still small cap, in a U.S. context?
Good question. I think Frontline still continues to be front and center in terms of investor interest. We get the most inbounds when people want to play tankers. Even last summer, when product rates started to rally, we went out and said, "Hey, buy Sting." Well, everybody went out and bought Frontline, and so that stock's done very well. I think it has that legacy name that everybody in oil and gas remembers from 20, 25 years ago as a stock that worked, and it's still the one that people buy today.
So what about you, Tate? What are you looking into except for tankers, which everybody's bullish on?
Yeah, to answer your initial question and where we're on the last couple of years, the names that had momentum last year for the whole year pulled back a little bit in the smaller cap land that I cover. I thought momentum would continue strongly, but I was a bit of contrarian on container ships in the last 2 years, and it's been great to see that sector come back. Today, I'm most positive on dry bulk, particularly where the stocks have gone month to date, and we heard from the panel before, but I think there are catalysts ahead, and I think it will surprise the upside next year.
Okay, last man standing.
Okay, so on my favorites right now, some of you guys have focused on the sectors, and I'm focusing more on specific situations. Now, on the LPG market, the VLGC players have already done really well, but I think Navigator is providing an interesting opportunity, maybe not for the next year, but maybe like towards the medium term. And then on the spicy side, you could look at TMP, but that has its own set of risks.
But if you want to make a profit for the next year, I mean, we're talking from marine money to marine money. I mean, that's the key here. People come here to get the best investments ideas they can get, to put the money down, so they can, beat you next year if you're wrong. So, John, what is that bet next year, next 12 months?
I don't see any reason why the tanker market doesn't continue to be strong. I mean, there's going to be ebbs and flows. I think the problem is, Omar brings up like Frontline's front and center, but it is still small relative to other investment opportunities in the United States. I'm sure the Oslo shipping index did phenomenally. I wonder if there was a New York Stock Exchange shipping index, how much better that would have done given the liquidity. But that being said, you need these positive catalysts. You need to sustain, I think, the NAVs moving up, make people understand that dividends are somewhat sustainable. Balance sheets are in a much stronger position than at any other point. You may have good memories from Frontline from 20 years ago, but you probably have bad memories from those stocks too in that period of time. So I tend to think there'll be volatility. 80,000 would be phenomenal. 100,000, wow. But if they make 50,000, I think every single tanker stock will be higher at this time next year than they are today.
I know it well. My hair is gray because of Frontline. I was in the middle of the
I thought that was Seadrill.
Yeah.
But Petter, you are hold on both my stocks, Avance Gas and Flex LNG. Is it possible you are wrong?
Yes, it's always possible to get it wrong. But that's one of the things that I got right recently, that downgrade. Sort of, as I wrote to you, it could have been sort of just management incompetency, but I chose to put it on valuation instead. It's been phenomenal for a couple of months now across everything. And that makes also things more difficult. Now there are periods in time in which, well, if you go 7-8 years back, the only people talking to us was sort of restructuring specialists. Now I get inbounds from yield-oriented investors. That's been quite a while. So the inflow of liquidity into the sector is coming from different pockets than it's been for many, many years.
It's quite interesting that you're not covering the best yielding stocks of the last 20 years. But maybe 13% is too rich. I mean, you want boom busters, don't you?
Well, yes, my audience wants them. So bank stocks, they can get someone else to cover.
So, what about container ships now with the Red Sea disruption?
Well, that's the key question, right? I think Red Sea is such an important factor. It's driven up distances by 12% actually in container shipping, and the fleet is growing by 10%. So it's more than enough covering the order book. But of course, nobody knows how long it will last. And sometime next year, who knows, it will reopen and container shipping could go down, right?
Yeah, but the container ships, the owners are back contracting a lot of ships, and some of the parts valuations, you get basically almost zero value on container ships in Maersk. I know you upgraded lately, Petter Haugen, so...
I like Maersk. I think Maersk is really attractive. Should be higher valuation, and I definitely think it's a trading sector, right? You should be light-footed. You could trade it for the next few months. Q2's earnings coming up. There's going to be higher guidance from the companies. Earnings are great. So in the short term, these stocks could go definitely higher. But of course, there's risk, and you need to think about it.
It's like going to the craps table. I mean, the container shipping market is strictly geopolitically driven, and nobody knows what the Houthis are going to do next. At least with tankers, I think you have a fundamental thesis behind it. You get the cream on top from the disruption associated with the Red Sea, but if that goes away, it's still a fundamentally strong business. In the container ship market, They were 2 months away from signing long-term contracts at money-losing levels before missiles started to be fired. So it's a complete crapshoot. If you think you have a read on what's happening in Yemen, by all means make an investment. If you don't, good, flip a coin.
Could it be sponsored by shipping companies?
It probably is.
So Omar, you know, you used to work at Clarksons, now you work Jefferies. I suspect that all of you here on the panel use Clarksons for your information flow. You know, is Frode manipulating the information you're using? You know, is it real?
I did notice there's a few things that throw me off every now and then, but no. No, I loved working with Frode. We worked together for 7 years, yeah. So it was a fun run, and I loved Clarksons. Enjoyed Jefferies very much as well. But no, I was going to say, just kind of following up on Frode and John's comments just about the container market, it's the only segment really in shipping that it went from very bad to very good as a result of the Red Sea. No other segment did that. And as John mentioned, the cream of the crop in tankers, that's where we found investors with the confidence to continue owning the names. Is they see the supply-demand balance as being very tight over the next several years, and the Red Sea is just gravy on top of that. Whereas containers, Frode, you just said you have to be very light-footed. But I think when we sit here a year from now, if we look at the stock performances across all the shipping, it's hard to say it. It's one of these ones where you just have to, you know, hold your nose, close your eyes, and jump in, but you have to buy Zim. Stock's at $20. In the third quarter, they're probably going to earn at least $5 to $6 of EPS. There's a dividend story coming back, and as we get closer to the end of this year, there's going to be this, we think, you know, coming to Jesus moment, perhaps, that, wait a second, this Red Sea situation is going to last into 2025, and that's just not factored in. Now, of course, John, you said you have to have some kind of, you know, crystal ball or some kind of understanding of what's happening with the Houthis, but it feels like the closer we get to year end, the more people are going to start to discount the fact that this is going to last deeper into 25.
Yeah, and I agree with Omar too, and the comment about it being a crapshoot in the container ship market too. The benefit of the sector is today being able to lock in 2-year contracts at 20,000 plus, and probably continuing through the rest of the, and even those terms probably going longer. I've in the past really liked that security of earnings in an uncertain market. But at the same time, why I'm pivoting to dry bulk a bit in the messaging today is just I feel the risk-reward balance is balanced to the reward side in dry bulk, particularly with the panel before. And there's new supply coming to the market with the Simandou mine. The gold in ocean is mentioned in 2025. And the biggest risk I see for the whole market on the dry bulk is a disruption in the supply, like we saw with the tailings dam collapse back in 2019. But I think that offsets that risk. So, and then on dividends, I salivate on your dividend yields on the Norwegian Stock Exchange, but there are still attractive dividends yields in the dry bulk space. And I actually launched on a small cap name this morning, United Maritime, USEA, that you can have an 11% dividend yield. So a bit comparable to yours.
And Climent, last year, you know, last Marine Money, hardly anyone here could probably spell Houthi. And now it's on everybody's lip.
Can you spell it?
Yeah. But you know, in 2025, what's the thing to look out for? What's the underanalyzed themes that we just don't pay attention to now, but that may have a real impact on the companies you cover?
I would say a couple, and maybe they are not underfollowed, but this is something that we'll closely monitor. The first would be regulations and their impact they will have on the supply side. I mean, we all are aware of the upcoming regulations. Some of them have already started to be enacted now, but this is something that we will feel the effect going forward. And then secondly, in this room right now, we all have you all have a lot of money laying around. And I'm really curious on the impact this will have on underlying shipping valuations going forward.
But so why don't we see more IPOs? You know, shipping market is great. Most of the ships in the world are owned by private owners. So if you look at the LNG shipping market, really, it's just Flex and Coolco, and there's tons of ships, but all of them are kept privately. So when you have these great markets, you should think that Wiley here from Morgan Stanley is doing more IPOs. Why are you not doing that, Wiley?
Omar, how many of your companies traded a premium to NAV?
I cover 27 or 28 companies, and maybe 5 or 6 of them do.
There you go. What's the point? Everyone's got so much
access to
money. Why do
capital.
they need access to capital? They're printing money.
Yeah, but you know, a lot of these kind of private owners are family owned, and they need to have a generational shift. And using the public markets is a good way of kind of moving on to a more professional way of running a family office.
So that's under the premise that they want to, that the next of kin want to get out of the business. They don't want to get out of the business. They want to stay in the business. It's a golden goose. So why open up your books to the public markets? I mean, it's been a frustration for 20 plus years for myself and Omar. You know, this whole IPO premise, it was a boom for 5 years. We all lived off it. It was amazing, but those times are over. I mean, bringing a 3-ship company that's going to grow to 10 ships in the next 5 years, whatever, I mean, those days are over. You have to be a multi-billion-dollar company, established, good balance sheet. We're not going to see these little tiny IPOs anymore.
Well, and to follow up just on that, John, you know, when these companies were coming public back in the 2000s, they were all coming with this gimmick of, hey, we're going to pay you 50% of cash flow as a dividend. Then it became 60. Others that followed said 70%, and then finally the last one said 100%. Now you have companies already that exist that are multi-billion market cap, and they're paying dividends. So what is it that a new entrant to the public markets is going to offer?
So it's nothing to do with you being a little lazy and not be willing to push companies and build those big enterprises.
Yeah, and I mean, does a company have a faster path to fleet growth than remaining private or being in the public markets? I think you could debate that, but I think there are situations that being public can lead to faster growth in a fleet. Still.
Actually, but John, you know, sorry, I'm jumping a little around. You've probably been doing this for longer than most on the panel here. You know, you were there in the early 2000s when the prior sort of boom really started. What's the difference in sort of the type of investors who approach you? I mean, do you notice is it different now than it was back 20 years ago?
I don't think it's a different type of investor. I think it's a different type of knowledge base. You know, in 2003, when the boom kind of really started, nobody knew anything about the industry. Maybe if you were involved in the bond markets in the late 90s, you had a negative muscle memory from it. But effectively, it was new. There was a period of like, you know, this Chinese insatiable growth period that'll probably never be replicated before. You were coming off of 2 decades of poor markets where the shipbuilding capacity had really dropped, so you couldn't respond with capacity immediately. And this was a very attractive story to people. But it was also a period of like, lack of transparency, you know? Omar or the Clarksons guys or myself, like reading people rates that we were getting from shipbrokers, it's way more transparent right now. And I think that these established companies that over cycles have built a bit of a reputation, mostly good, but some bad, those are the ones now where if you're gonna see an upturn, you're gonna have a little bit more trust in. These new upstarts that seem, I mean, what a great word, gimmick, that Omar said, not me, my bank would never say that. But using a word like that, yeah, I mean, that's kind of what that period was. I mean, there was 50 IPOs in 5 years. How many of those are left?
So, but it's actually quite interesting, you know, because you've been there, again, you were there 20 years ago, when it was really, obviously, underappreciated, or certainly not many paid much attention to it. So how come you ended up? Was it sort of like a short end of the stick kind of thing, you know, that you ended up, you know, with, you know, dang, yeah, I got shipping, how can I live off this?
It was just fortuitous timing. I mean, really, JP Morgan could have put it in energy, they put it in transports, I got it, 31, just rode the wave for 5 years, leveraged it for 10 more years of just holding onto the chop, and then transitioned out, just in time.
Had you seen a ship before, then?
I've been on several ships before, yeah.
But you, Petter, you know, how did you stumble into it?
Well, when I came to shipping, I started with the dry bulk industry back in 2007. And I looked at the charts, and I could tell that was not a normal sort of state of things, with Capesizes earning $100,000 per day. But I looked around, and everyone was behaving like this was normal. Nothing, well, more or less. But if I might step back, I think, of course, the next, if it comes, IPO wave will need premium valuations of current companies listed today. And over the past few months, we've seen some of it. And there are some companies now trading at premiums, not all of them, but if you go, well, 3-4 weeks back, Frontline was, at least on my NAV, almost 1.5. And I don't know with you guys, but I talk to projects now, small things, which is thinking about listings. So there are things in the pipeline, and all we need is valuation. And valuation is, well, dependent on rates. So if your $80,000 for Q4 is right, which I think is conservative, I think we could see something already this sort of next 6 months, next 8 to 9 months then.
So New York is an extremely expensive city. You know, people are paying a lot of money to go here, so they have to make some money as well. So what are your best tips for your stock advice for the next 12 months? So we start with you, Clemens.
I would go for either TMP or Navigator. That's what I mentioned before. And yeah, those are my two picks. One is more on the conservative side and more of a medium-term story. The other one is more contingent on management's actions. If they do the right things, there is a lot of upside, but will they? We'll see.
But we need a long and a short.
As a long, both.
Yeah.
So Tate, what about you? You are into dry bulk, and I can understand that. I believe order book to fleet is 6%, which is ridiculously low, probably the lowest in 30 years or so.
Yeah, and we've heard, I mean, the dry bulk data we mentioned can be a bit esoteric, but I think the underpinning data in terms of steel demand from China, the Navy buildup, and Cape-size ships, the only pure Cape-size play in the market, recommending Synergy, SHIP. It's down 17% month to date. It's only a month and a half removed from a 52-week high. It's increased its dividend payouts 2 quarters in a row. It has repurchased shares in the last year. SHIP, the only Cape-size focused name.
I have a suspicion that Omar and Frode is going to be agreeing that Frontline is the best stock, but let's check it out.
You beat me to it, but yeah, Frontline definitely. Just in terms of the fact that they obviously have the big VLCC fleet, and even though that market isn't doing so well at the moment, they can fall back on the Suezmaxes and the LR2s, which are doing phenomenally well. And so you get paid to wait, and then you have what we think is a brewing buildup in this VLCCs. The way we think of it is VLCCs are stuck in a pressure cooker, and the lid's about to come off. And whether that happens in the fourth quarter or not is to be seen, but it's coming.
And the short is flex?
I have one underweight, unfortunately, yes. Yeah. But no.
So Frode?
Yeah, I tend to agree with Omar. It's my favorite way of looking at these stocks is to try to what's priced in, right? And I look at cash flow and want to, back out what the type of day rate is in priced in. So when I look at Frontline, you need like 52,000 per day to defend that stock price today. If you believe on non-eco VLCCs, if you believe in higher rates than that, that's obviously upside potential. Frontline is obviously priced higher than the rest of the peer group. The rest of the peer group is roughly 9-10-year-old fleet. And if you go buy a 10-year-old VLCC, 85 million, and you look at that and try to calculate what the day rate you need to have, the answer is around 41,000, depending on the, if I'm using 11.5 return. So in order to believe in the ship values used in the NAVs, we need like something more than 40,000 to defend the current ship values. When I look at the supply and demand, rates will be much higher than 40,000 and much higher than 50,000. Right? So yeah, tanker stocks are up 4 or 5 times, but there's still more to go. So
okay, and Jonathan, I guess your buy recommendation is NAT?
Sure. No. That would be my source of funds for whatever other tanker you want to own. How about that?
But one question is, not only, to both of you for that matter, back to Frontline. Why is it that Frontline is priced, call it, way over the others in terms of steel value? I mean, what is the secret sauce? And why aren't you able to persuade the others to do what it takes to balance it out? But it's kind of interesting when you look at it over time. You can say, well, Frontline is always priced over NAV. Others are priced way below NAV. But almost at any point in time, if you invested in either of them, Frontline would overperform. So even though it's more expensive, it's still very very frequently even a better performing stock than underpriced. So there must be something fundamental here. Maybe John, what's your take?
Yeah, so my take, maybe a bit more nuanced than it would have been 5 years ago, is I think it's risk reward and what the management team is willing to accept from a risk basis. There's been a lot of companies that have been very close to being put to the sword. Some have. Frontline's been close a few times, but they have a backstop, and they have a very rich backstop. And a lot of the other companies don't have that. So when you're really running out of liquidity and you need a geopolitical event to pull you out of the, the liquidation bucket, maybe you don't get so aggressive with your dividend strategy, with your leverage strategy anymore. But Frontline has the, the luxury of being able to do that. And you're right, over time, it's like investing in the stock market. If you ride it for like over a period of time, you're going to do great. But man, if you top tick that on the downside and ride the downside, it's very punitive. But again, there's a backstop there that others just don't have the luxury of.
I also want to get Petter's buy recommendation, because Petter here has been voted 2 years in a row the best shipping analyst in Norway. One of the few people who are bullish on the VLGC market in 2023, when his favorite top pick was Avance Gas, which I believe went up 208% in 2023. So what is your advice these days?
That's very kind of you, Stein. Thank you. I'm a bit embarrassed, I can feel. But and just to add to that, I was at the point also worried about the 2023 order book. So yesterday you said that I was not worried. I was worried inside at least. Perhaps I wasn't showing it very clearly.
No, but I guess that's because you got the Flex LNG bed linen set.
That's true. That's true. I have the sunglasses, the bed linens, and the towel. Not to speak of that, I'm using that every day. Okay, no, but
Some lubrication as well?
But still, he has a whole recommendation.
Okay, I got more things, but that's not to speak of from the stage. I'm sorry. Wallenius Wilhelmsen.
Which one, the top co or the operating?
No, the operating one. I think, it's been a very good ride for some time already, and I read the market as expecting rates to fall off a cliff in not too distant future. Yes, the order book is a worry, but 2024 is not going to be the year in which that market crashes. Wallenius Wilhelmsen is still to improve on their dividend, on their payouts. I think you'll see the first sign of that in Q2, and that's going to be a positive catalyst. With that said, sort of from an investment standpoint, if you look a few years down the road, tankers is just phenomenal, really. It's a yard capacity situation, and you said that, John. Last time, when you came into sort of the China boom, yard capacity stood at some 4% of the fleet. We doubled that into 2011-12. Now we're back again. So yard capacity in combination with the order books, and it also sort of applies to dry bulk, is making this something not that dissimilar from 2002, 3, 4. The question asked by our hosts here, whether this looks like 2006 or 2008, that was an email you sent out. This is not 2006 or 2008. This is before that. And it could last for quite some time. But the best money to be made over the next 3 months is Wallenius Wilhelmsen.
But okay, if you buy the Wilhelmsen Group share instead, how much implicit discount you get on the Wallenius Wilhelmsen stock?
You know, we don't cover the holding company, but last time I checked, you had more than the full market cap of the holding company within the holdings of the Wallenius Wilhelmsen shares. But yeah.
But you don't expect any change in dividend policy in that company, maybe?
As I said, I don't cover that, and but no, I think that's fair to say that no one really expects the holding company to change much.
Petter here is probably the definition of a bullish analyst. Have you ever been short anything?
Yes, we've had seller recommendations, but of the past, I was here in 2018, I think, and spoke about what I thought to be a very, very good tank market in 2020. And I would have done exactly the same again. The pandemic destroyed that. But for some time, we've seen that ordering in general has been slower. than for, well, at least the prior decade to it. And much of it is due, of course, that we are still worried about 10 and 20 years of demand in terms of, well, in particular, fossil energy carriers. So we have some worries, which we didn't have at all back in 2007-8. But we do have them now, and it's been difficult to get banks on board to finance ships. It's been difficult to convince investors in times in which dividends were rare. Back in 2016-17, you even had in dry bulk some companies struggling. So we've been through 15 years with not very good markets, some ups and downs, but generally bad markets. And now yard capacity is back below where it started in the late 90s. And we're, of course, worrying for globalization decay. So there will always be reasons to be worried, and we will make mistakes. But this time, and it's been so for some years, there are good reasons to think that we'll need more capital to come into this industry. And if that's going to happen, prices need to lead the way. And we've seen that now on the new building side, and we've started to see it on earnings as well. And it's going to be, I think, in tankers, in dry bulk, many good years to come.
It's kind of interesting because capital is coming in from the audience here today. I mean, they're now putting down money for your bets for the next year. But more importantly, I mean, again, there are fees to be paid to attend this conference. So, hard-earned cash. We have summer holidays coming up in a few weeks' time. Omar, what do you do for the next 4 weeks that can sort of basically finance everybody's summer holiday? What's the trade?
Wow, 4 weeks. I guess you just fall back on Zim. That's the one. That's
I just have to open my Robin Hood app. Just wait a bit.
Yeah.
I'll take one. I mean, the topic for this panel was value. Is there value in the shipping sector? I strongly think there is. You still have many stocks trading well below GAAP book value per share, let alone net asset value per share. You have some stocks with short interest well above 7%. I cover one. I think I'm the only analyst that covers it. Imperial Petroleum, IMPP, 13% short interest. Does not make sense to me in this market. I think that's where you make money in the next 4 weeks.
Climent, what do you buy to go down and right on the wine list by early August on your whole summer holiday?
For that sort of time, we would need like a lot of risk to be able to a lot of money. And I think flipping a coin and deciding between calls or puts on Zim would be a goal.
Yeah. And you, John?
I mean, frankly, it's an absurd question. No offense, but I mean, like, what
you don't want to,
it doesn't
so you don't want to be caught out.
It doesn't matter how like cheap a stock is. If there's not a catalyst for it in the next 4 weeks, nothing's going to happen. So I mean, what's the sector where rates are going to spike? Omar's probably right. I mean, container ships have been parabolic the last 5 weeks. Probably nothing stops that the next 4. Product tanker rates have really started to rip in the last couple of days. So maybe you get some leverage from Scorpio. But it's kind of a dearth of, July's a slow period anyway, typically for the tanker markets. No one's going to be reporting earnings. There's going to be no real kind of like news around any of the names. So you just got to ride like an anomalous spike in rates. And if you can call that one, by all means, go to Greece for August.
Okay, but what kind of stock should you avoid then? So we have to get the bearish side here as well. So we start with you, Omar. Except for Flex, where you have a hold.
I don't think you have to avoid any stocks, to be honest. The sector is very tight. When we look across the different segments in shipping, I think one of the big takeaways I had coming back from Posidonia was just how the container market is giving a gift to everybody in shipping. They're taking 200 slots, was the talk. And so they're going to fill up the shipyards through the end of the decade, which means that tankers, dry bulk, all the segments are going to see limited capacity available to them. So I think the sector looks really good for the long term. I think that's the interesting thing about this sector is when we look at tankers, we're in year 3 now of very strong earnings. The free cash flow yields are still too high. In last cycle, when people were very excited about the space, the stocks traded to a 14 or 15% free cash flow yield. Now they're at 20. That's lower than 25 a year ago, but 20 still is very, very rich in terms of what you can get. I think that as time goes on, the market's going to start to accept a lower and lower free cash flow yield given how long the cycle is set to last.
Tailing what Omar said, I mean, maybe from a technical standpoint, companies that have been very active in repurchases in the last year maybe will be less active going forward, so maybe a little bit of underperformance there. Whereas on the other flip side, companies that have not been that active on repurchases screen for those kind of companies with this favorable market of inelastic supply.
Okay, Clemens, what's your short?
That's a tough question. I wouldn't short anything right now, but I would be really nimble in some sectors. So that's what I said first. Like, I prefer to be company specific. I don't have like a specific sector I'm extremely bullish on, nor anyone that I'm bearish on. I just try to be nimble on the companies I recommend.
Okay, Jonathan, I know you're short NAT, so maybe we go for Frode then.
Well, I'm skeptical about car carriers and LPG, or VLGCs to be specific. Panama Canal has been super important for VLGCs. It seems to be opening up now.
I think that happened at the right time because you had a lot of ships for delivery in a very short space of time, and that the Panama congestion happened at that time was like perfect.
Yeah.
Because you had export growth in the US 10%, and then you got the Panama congestion. So even if we come back now to less Panama congestion, fleet growth is much lower near term.
Yeah, but you have accumulated a lot of fleet growth, so it's still growing. 8-9% this year, 5-6% next year. LPG exports, according to the EIA, is slowing down a lot. Just 2 million tons exports.
So what I gather out of
Short
this.
advance.
So I was just going to say I gather is short BV LPG. So then last one, Petter.
Well, I'll look for a shipping fund, which is short shipping, and I'll short that one.
Okay.
And with that, thank you very much to the panelists. We know where to put your money.